On the first of the month, the notification hits, salary credited. It feels like anything is possible. The new phone, the vacation, clearing out the old bills. But by the 20th, that feeling vanishes, replaced by a sudden, creeping panic. You're in survival mode, counting exactly how much is left to make it through the final week. This cycle is driven by a specific emotional trigger that keeps the middle class trapped. The desire for pleasure right now, combined with a promise to handle the pain later. Banks understand this impulse perfectly. They offer a credit card or an EMI plan for that new iPhone, giving you immediate access to a status symbol that loses value every day. When the bill arrives, they offer an easy out. Just pay the minimum due. You get the phone today, and they get a customer locked into a high-interest debt cycle for years. This logic extends to the biggest purchase of all, the 20-year residential home loan. Society treats this as the ultimate sign of success, but unless that property is generating cash for you every month, it is an expense. It pulls money out of your pocket rather than putting it in. What we are conditioned to view as personal investments are often just efficient mechanisms designed to build the bank's wealth. Every interest payment and minimum due systematically trains your capital to pad their balance sheet. To defend against this, the standard middle-class strategy is to hoard cash in fixed deposits or standard life insurance policies. They feel safe because the numbers on the screen slowly climb, but there is a silent mechanism working against those savings every single day: inflation. It doesn't take the money out of your account, it simply erodes what that money can actually buy. Look at the cost of everyday commodities from 20 years ago. Back then, a single liter of petrol cost around 30 rupees. Today, that exact same liter costs over 100. The fuel hasn't changed, but the power of the currency has been diluted. This chart compares a typical 6% return from a fixed deposit against modern economic realities. When that return is measured against a 7% general inflation rate and a 14% medical inflation rate, the safe FD is actually losing value. The result is a widening gap between the numbers in your account and the reality of what you can afford. Without a strategy to outpace these rising costs, the middle class stays locked in a cycle of diminishing returns. If saving money alone doesn't build wealth, we must look at what the wealthy do differently. They don't avoid debt, they use it to gain control of assets that pay for the debt itself. The distinction is in the destination of the money. Bad debt is borrowing to fund a lifestyle, taking a loan for a car, an expensive vacation, or new electronics, items that lose value the moment the transaction is complete. Good debt is borrowing money specifically to acquire assets. These are investments that put cash into your pocket every month, or grow in value at a rate that far outpaces the interest on the loan. Take a high-end smartphone. If you buy a 1.5 lakh rupee phone on EMI just for status, it's a liability. But if you use that same smartphone to shoot monetized content that generates 25,000 rupees a month for you, the phone becomes an income-generating tool. It pays for its own existence. This chart shows the structural advantage of a business mindset. A salaried employee earns money, pays tax immediately, and tries to survive on what's left. A business owner earns money, spends it on deductible assets and expenses, and only pays tax on what remains. They use the tax code to keep more of their capital working. Debt is just a tool. Your wealth isn't determined by the size of the loan, but by whether that loan is purchasing a lifestyle or a cash-flowing asset. Let's apply this to real estate. A residential flat often loses its appeal as the design and construction age over 20 years. However, a commercial shop space in a developing area is different. Its value is tied to the local economy, and its rental income tends to rise as the area becomes more established. You don't need the full price to secure a shop. You can use a smaller down payment, say 10 lakhs, to secure a 40 lakh rupee loan for a commercial property. This is the crossover effect. Your EMI is fixed, but commercial rent rises annually. The graph shows when rental income covers the bank payment. Once cleared, rent becomes pure income. You own the asset outright, using the tenant's money to pay the bank. This is the core of smart debt, using a loan to acquire an asset that is capable of paying for itself. For those who want to avoid the banking system entirely, there is another path to hide the assets: real estate syndication. Instead of an individual loan, form a private limited company with trusted investors. You pool your capital to buy at a scale impossible alone. If 10 people contribute 5 lakh rupees each, the group has 50 lakhs in cash. This allows you to buy a premium commercial property outright, with no interest payments and no bank involvement. Each person becomes a shareholder in a high-performing asset. You share in the monthly rental income and the long-term appreciation of the property, building wealth without the pressure of a monthly EMI. Earning is a skill, and saving is an art. But the real shift happens when you stop working for your money and start using it to acquire assets that work for you. True independence isn't about the size of your paycheck. It's about how much of your wealth is growing while you sleep.